Hello everyone, it's Chris with Trekking for My Future. Well, sorry for the hiatus I've taken on this channel. Um, I spent a lot of time working on my job and putting in money and everything into my account and focusing on my expat theory channel and kind of just let this channel sit for a little bit. It's probably been, about 6 months since I've actually posted over here. And I wanted to do a financial update and talk about my portfolio a little bit. I'm here in Joliet, Illinois at my headquarters, and I bumped into a kindred spirit yesterday. Another individual, another driver here, who is also into the stock market. And it's really surprising how few people, especially drivers, that really just not interested in trying to build their wealth through the stock market. So it's kind of rare when I run into somebody who's actually doing the same thing I'm doing. And I met a gentleman named John last night who's been doing this for longer than me. He's been doing it for about 4 years. And he's got a sweet portfolio going. A little green and envy here because I would love to have the account he's got going. And he's got a little bit of a different strategy than I do, but he's working it really good. And over on Expat Theory, I actually did a financial video, and there was a couple of comments made about my portfolio. And I kind of wanted to go over things a little bit. In my portfolio, I'll show you some screenshots here of what's going on with my portfolio and talk about individual stocks and things. But as a whole, I'm not really doing dollar cost averaging per se. And if you don't know what that is it's basically setting yourself up on a schedule to regularly buy stocks a certain amount at a certain time on a regular routine. Regardless of what the stock price is, you're basically playing the law of averages, that it's all going to average out in the end. Some people would say I'm kind of trying to time the market, but I don't quite see it that way, because I'm not really trying to play that kind of game. I just know where the low point is for the last year for a stock. I look this up. I look up where their low point was, where their high point was, and the cost of their stock. And I look at where it is right now. And I just try to catch it on a discount. So, if it's running about the middle of the two ranges, between its high and low, and I catch it where it drops, 50 cents, that's where I'll buy. And then if it drops again, I'll buy a little more, Constantly trying to lower the average cost that I've put in to buy the stock. So it's kind of a modified dollar cost averaging, because I do buy at regular intervals. And I can't say that I do a regular amount. I basically transfer into my stock portfolio account whatever I can afford to put in at whatever time it may be. It might be, I can put in $500 this week or this month. I might be able to put in, $2,500 for the month. Or, this week I put in $1,000. It kind of varies. And I look at my portfolio and I look at where my bargains are. And those are the stocks that I will increase. But I also modify this strategy a little bit by the industry. I feel a little sensitive to the risk factors of the industry, of current economic situations. Good example is Good, G-O-O-D. That's one of my investments. They are a monthly dividend payer. They are a real estate company, and they invest heavily into commercial properties. Now, I have two real estate companies that I invest in. I have two business to business loan companies that I invest in. Um, I kind of spread out. I have something in the oil industry. I have something in the communications tech field. I've got a little Tesla. Um, I have banking, and you know, I'm kind of diversified into different areas. But I have two of the real estates. The good is very much focused on commercial properties, which is in the tank right now. So my sensitivity to the risk level of what's going on in the commercial properties area right now definitely plays a massive role in the amount of money that I'm actually going to put into good. I don't want to keep pumping money into good knowing that the commercial real estate is struggling. Now, my other real estate is a more mixed uh, investment for different types of real estate. So they're actually faring a little better because they're not so heavily into the commercial. So that one is the one I'm kind of, when I want to put more into the real estate, I go to the other one right now. And I don't want to get too heavily invested into companies that they pay high dividend yields, but they're like business to business loan people. They finance companies to expand and grow their core business by borrowing cash from someone else. They might have an add-on, or they build a new location or something of that nature, and then they pay back that loan to the company that lent them the money for their expansion. Those companies do well in the investing world, and they're good companies to get involved in, but we all know the economic situation that we're in right now. They keep raising the interest rates. Less and less of the companies are looking to really grow and expand right now. So the business has kind of dropped off a bit for those companies that provide these loans. Kind of a good time to get into a good position, but you don't want to be overextended into that in case that company doesn't weather the storm. So you don't want to take losses that way. So I'm very sensitive to the risk factors of what's going on within the economic world. Another one of the comments that was kind of made, they were saying to kind of even out all of my allocations and how much I have in each position. And honestly, like I said, based on the market and based on the economy and the factors that are going on out there, my tolerance for risk, I see no benefit. Actually, I see danger in trying to equalize each one of my positions to the same amount of money. Each position has a different risk level. So I'm kind of more watching that than just kind of going with a standard idea of some sort of equity in each position, being the same amount invested, and dollar cost averaging into those accounts at the same level on a regular basis. That's not a strategy I follow. Now, if that works for you, hey, it's investing. You can do what you want. And if it works and makes you money, more power to you. I'm just a little more sensitive to risk level. I really don't want to lose anything. I can't really afford to lose money coming into my retirement in a short time frame. I really need growth, and I need solid growth for my dividends. And I can't really afford to take too many losses. Another comment that was made, when I show you my screenshots here, they were a little concerned about being into ETFs that might have overlap. Now, if you're not familiar with an ETF, it's an exchange traded fund. Basically what they do is this company will set up a basket or a box of stocks. They buy stocks based on a strategy or a theory. A lot of times it's based on the NASDAQ, or it's based on the S&P 500, which is the top 500 companies on the stock market. NASDAQ is the top companies in the tech field, or the Dow Jones Industrial, which is exactly what they're saying, industrial companies, the top companies out there. But the S&P 500, which is basically just your top 500 of the entire market, U.S. market. But different funds focus on different things in the economic world. They have different characteristics for each one of these funds. They might be focused on dividends. They might be focused on market cap. They might be focused on all these different aspects. And it's called weighted, how it's weighted. And each fund may be weighted differently. So even though it's buying in on the S&P 500, which is the top 500 companies, the top 10 of their holdings may be wildly different based on the criteria that they've established for this fund of what it's focused on doing. Therefore, that being said, when I have an investment to one ETF, DIVO, and I have another investment into an ETF, which is SCHD, they're both ETFs based on the S&P 500, but because they're weighted differently, the only real overlap I have is both ETFs in their top 10, Chevron shows up. I'm okay with that. I'm okay with a little overlap in a good company like Chevron. I have bought Verizon stock. I have bought JP Morgan Chase stock. Both of those do show up in the ETFs. They're top companies in the S&P 500. But I'm perfectly fine with that because I feel strongly about these companies and want to invest more because I do believe they're going to be good companies, good performers, and have a good return on my money, not only in the ETF itself, but so much so that I've directly invested into those companies. So hopefully that will kind of answer any questions about, the overlap. And, it's very minimal. And I think the person who made the comment may not have understood on the two ETFs that I have that are run by JP Morgan. One is JEPQ and one is JEPI. JEPQ and JEPI. Now both of these are run by Chase and they're covered calls. A covered call ETF is different from a regular ETF in the way that they are actually selling calls, buying and selling calls and options on stocks versus a standard regular ETF, which is actually buying stocks itself. And for those of you who don't understand this is a little deep and a little complicated, but what they're doing is they're out there betting on whether the stock price is going to go up or go down. And they make money through this process. So a portion of the funds that they get when you buy into that fund is being used to do these bets on the stock price going up or down. And it's not the same thing as a traditional ETF that literally buys the stock and it holds it. And the price either goes up or down, and they get the dividends off of those stocks, and they pay out dividends to the people who bought into the fund. It's a little different animal. JEPQ is based on the Nasdaq, the Nasdaq index, and the S&P 500 is the JEPI. So they may have misunderstood that JEPI, DEVO, and STHD are all based on the S&P 500, but they have different ways of going about it. They have different weighting on their top investments, and they're different animals. They're all animals in the zoo, but they're not the same. And they all have their ups and downs as to why I invest in them, and they have different basis of returns. So it's not as overlapping as one would think. Okay, looking at the first screenshot here, this is my Webull account. The larger number in white is what the value of my portfolio is right now. The red number below it is showing you that I'm down a little bit. But if you combine those two numbers, you see that I've got about 40,800 into my Webull account. It shows I have 14 positions, and the positions down below there, the ones that are in green are the ones that I'm up on, and the ones that are in red are the ones I'm a little bit down on. All right, and here's page 2 of the 14 positions that I have. And technically, I actually only really have 13, because the AMC stock there, APE, that's just something I was kind of playing around with. I threw a couple $100 at it just to see what it was going to do. There's so much controversy and turmoil going on with the AMC stock. I took a risk by just throwing a little bit at it to see what would play out, and that's it. All right, and this screen shows you the dividend payments that I've received based on the about 13 months or so that I've been doing this investing in this Webull. So in about 13 months, I've made just about $1,700 in dividend payments off of my investments. And this is a screenshot showing the top 10 holdings in the DIVO, D-I-V-O ETF. So I kind of wanted to show you this one and the SCHD to show you the top 10 holdings and how they're different because they're weighted differently, even though both are ETFs that are based on the S&P 500. All right, so here is the SCHD, the top 10 holdings. And if you notice, like I said before, it's pretty much mostly just Chevron is the only real overlap. And of course, the stock purchases that I've made directly into JP Morgan Chase and Verizon, which I'm perfectly fine with. All right, so that goes to show you, very openly, very honestly, very candidly, factual. There's where I'm at. That's my Webull. Now, keep in mind, I also do have a Roth IRA that I am investing in, and that's done through Chase as well as my normal banking is done through Chase. And over in the IRA right now, I'm a little over 20 grand. I can only put a little bit more in to maximize it for 2023. As I've mentioned before, with the Roth IRA, they allow you a certain amount every year, well, based on your age too. At age 50 plus, like me, you can put $7,000 a year in there. In 2023, that went up to $7,500. So I plan on maximizing that every year, on top of building into the Webull. The Roth IRA is money that's being contributed after taxes. So when I go to collect it, it will be tax free because that money's already been taxed previously. So the Webull account that will always incur taxes, whether I'm getting the dividends or whether I'm actually selling stock for the cash, that's all going to be taxed. So those are issues and things that I do have to keep in mind for the retirement. I have to watch myself on the taxes so I don't get myself into a situation there. But anyway, guys, that's the financial end of it. That's the trucking is fueling all of this investing and savings and so forth. Um, I just got to keep it up. It's just a matter of uh, continuing to do what I'm doing and maybe even doing more to build that up as much as possible, so that whatever I can achieve through the market in monthly dividends will augment the Social Security enough to where I will have a decent lifestyle based on my budget. So the goal is 500 a month. I don't know. I kind of have a sneaking suspicion that if I really focus hard, I'm going to do way better than that. Um, the market right now is all down. Everything's down. I mean, you guys know what's going on with the economy. Economy's kind of in the tank. Um, our current administration is really not doing much. Hello, darkness, my old friend. Our current administration really isn't doing a whole lot to help with the situation with the economy right now. So I have a feeling it's going to take an administration change for the stock market to really, really straighten out and take off. But I'm trying to line myself up now as much as possible and buying in at lower prices as much as possible so that when it does take off, I get the maximum benefit and the maximum profits off of it. So I'm really not holding back cash in reserve. I'm really not holding enough cash in reserve. And I know it. I'm really pumping everything I get straight into the stock market because of the timing. It's just, it's hard to say no. It's hard to not buy when you're going to be getting good companies at a major discount. If you look back at that screenshot of my JP Morgan Chase, my average price on that is about 114. The analysts for that stock say that it should be on average $140 plus stock, and I picked it up at 114. The analysts also say that if it just goes, bonkers and goes crazy, that could be $170, $180 stock. That's a huge chunk of money to me when we're talking about I have 80 shares. And then on top of that, they are a quarterly dividend payer at just under 4%. So I'm getting paid every quarter for that investment that's actually making me more money. So that's king of my portfolio right now. It's my best investment and it's making me the most money right now. And I plan on trying to catch more like that and build on those type of successful purchases. So anyway, guys, I'm gonna wrap that up right now. That is a dive into where I'm at in my financials, and everything I'm doing is being fueled by this trucking and trying to get that portfolio built up. So if you have any questions or comments, feel free to drop them below. If you know anybody that might be interested in this kind of content, please share it to them. And people that are interested in the investing seem to be fewer and far between, especially right now with the economy doing this crazy backflips that it's doing. A lot of people are gun shy of dealing with the stock market. But one of the things that people just don't understand is when the economy's down and the stock market is down, that's the best time to buy. Fortunes are made when you catch these things at the low. And then at some point, they're going to go high. And that's where you make your money. So anyway, guys, I'm going to end the video here. Thanks for watching, and we'll see you guys in the next one.